live. It's gonna be pretty fun. I'm gonna talk about how you can use a fund to scale a concrete business, how to use a fund to scale a restaurant, a car wash, an Amazon store. We actually have some cool people doing Amazon stores right now. How you could use it to scale your farm, whatever business you have right now. You can bolt on a fund and actually scale it pretty effectively, which is kind of cool. So welcome in, y'all. This is a live stream. So say hi, say hello in the chat. Love to hear from y'all. I'm gonna pull up the chat right here. Be fun to see you guys. So funds, businesses, how they work together. It's funny enough. So I was 2 weeks ago, I was with Russell Brunson. If you guys know Russell Brunson, I was at his Category Kings meeting. There's probably 15 to 20 of us in a room, and everyone got a chance to go on stage and present something to the group. So I'm with all these online marketer people, and I get up and me and Mason are up there, and we say, hey, we want to teach you guys about investment funds. And we actually pull out the whiteboard and we started to teach them this concept of funds and how they could use a fund to take their business to the second or third or fourth level. It's funny enough, all these online marketer types and people like us, the way we think about scaling our businesses is, okay, we need either more leads or more, we need better. So either it's better fulfillment, we need better leads, we need to make more money per customer, or make just more offers to our existing customer base. So a few ways to make more money in business. Now, so oftentimes that results in, okay, we need to add more marketing funnels. We need to add better fulfillment. We need to have a big dramatic demonstration. We need to throw an event or something to scale to beat our competitors. See, what's the difference between regular, I would call them 7-figure entrepreneurs, and 8 and 9 and even 10-figure entrepreneurs, is they forget about a key piece of leverage called capital. And what can happen is, instead of, if let's say you're running a business doing $4 million a year, and you're kind of small, you've got 20 employees or 15 employees. And I was there a little bit ago in a business, and we're doing okay. How do we scale? And all those thoughts go through your brain. Well, we could hire another marketing person. We could do more lead flow. We could run Amazon, TikTok ads, or YouTube ads. Or you can set up a fund and buy your competitors. That's the next tier of entrepreneurship. You, instead of just trying to build, you just go buy. You buy out those competitors. And there's 3 ways to build a new company or develop. You can either buy, build, or partner. A lot of people think about building. We could build a new software. We can maybe even partner with a software, but very, very few people think about buying an existing company. You just acquire. If your competitor, another group, has all the leads or all the customers, your perfect clientele, maybe you start up a side fund and use that fund to go buy out all your competitors. Kind of a cool idea. So today I want to talk about what this means, how it could work. So funny enough, I'm in this group with Russell Brunson, and he is doing this right now. If you guys have seen Russell, he's talked about this a lot. He purchased a company called Magnetic Marketing. This was a company for one of his mentors early on, does marketing. He wanted to buy them. He's like, yeah, we're going to buy them because they have such a valuable list, and we can grab that list and bring it in. It'll both coincide with our current existing businesses. He's gone out now and bought a bunch of other companies that apparently are supposed to come and help his current company, and they can kind of cross promote and help each other's companies as an ecosystem. You can do this too. This is the difference. And this is how a lot of companies go catastrophic. If you look at Amazon right now, or Google, or all these big companies, they typically aren't building new product per se. Now, some of them do. They come up with a product every few years. They put a ton of R&D into it. But a lot of times they are buying existing. They're doing a lot of M&A, mergers and acquisitions. They're acquiring businesses at scale. Google Ventures they're plowing capital. Facebook, Apple, all these companies are plowing capital into businesses, either to buy the business and just squander it so there's no competition, or number 2, buy the business and use those lead flows and generate a brand new revenue stream. So for example, look at what Disney is doing right now. So Disney, for a long time, was they still kill it, but they were kind of stuck with their Disney audience, people that like princesses and animated films. That was their audience, which they had a big audience. They did very well with. What did they do a few years ago? They made people call them two of the greatest acquisitions of all time. They bought the Lucasfilm and Star Wars franchise, and they bought the Marvel franchise. Okay. And a lot of people know this, billions of dollars they spent on this. But what did it do? It expanded their audience and network base massively. And what can they do now? They put their products, their toys, those little stuffed animals in all of their Disney parks. They go across where they have new Star Wars land. They have Marvel stuff coming out in those different Disney parks. And ta-da, it adds a new customer base that probably doesn't care about Disney princesses, but might care about Star Wars or Marvel. All of a sudden is in their ecosystem and spending dollars with them. Kind of cool, right? Did you also know Disney purchased Hulu? They purchase ESPN, National Geographic. These are all the types of companies Disney is buying to grab different audiences. That's the next tier of scale that I'm talking about. Does that kind of make sense? This is the world of private equity. You can use this in your business. So I want to give you a few examples of businesses that we have worked with that are using this right now. Does that sound good? Type a yes in the chat. That helps out a little bit. Would that be kind of cool to walk through? Okay, so let me talk about a few ones that are kind of cool. I got a guy called me a little bit ago. He's like, Bridger, I've got a successful gun and ammo store. So they sell guns. I think they're in Utah. And he's like, Bridger, I want to go out and buy and scale. I've heard about funds. I want to buy competitors. What should I do? And he says, I'm thinking about giving up like 30% of my business, kind of like Shark Tank. 30% of my business, I'll go raise $8 million and I will bring money in and then we'll make acquisitions. I said, no, don't do that. Okay. There's a lot of other better ways to do that. Number one, you could set up a side vehicle of like I would call a fund or a syndication. So leave your existing business, set up a side vehicle, raise the money into that side vehicle, and then that vehicle goes and makes the acquisitions of the other companies. So your existing business has no change to it. It just stays the same. You set up a new fund or a syndication that buys all your competitors. And now the new fund gives you a contract to your existing business. Hey, we'll pay you a corporate override fee of 5 or 7% of revenue to manage all of these stores. And ta-da, you own both companies. So it's you all together, but you then get to manage these new companies. You split revenues with your investors and yourself, and you can now scale and take over and have a monopoly on an entire area or ecosystem. So this guy, his plan was to take over, it was like 2 or 3 states. He wanted to buy out all of the gun stores in these 2 or 3 states. He'd have a monopoly on them. They could share customers, clientele, the whole thing, which is kind of cool, right? That's thinking like an 8, 9, 10 figure entrepreneur. Okay, that's the next tier. So I was telling this group in Boise, I was like, dude, this is the next tier for you guys. Think through this. And by the way, I walked them through this, and I had probably 10 people after come up to me, Bridger, oh my gosh, we want to buy chiropractor shops. We do marketing for chiropractors. Why don't we just buy these chiropractors and do the marketing for them, right? Instead of being a service or an agency for these companies, we'll just go buy the companies, and then we can just help service them. Does that kind of make sense? Another example, Amazon stores. It's a cool example. A couple guys in our group are doing this. What they do is they'll raise a pool of money instead of grinding the ground floor and starting up Amazon stores. And as you guys know, you sell on Amazon. A lot of the stores on Amazon are people that run those. They source products, put them together. It takes a lot of work to build an Amazon store, build reviews, all that kind of stuff. Instead of building an Amazon store, they just go buy them. So they raised $250,000 in a fund. I'm using my hands here. And they would go buy up 5 or 6 stores, group them together. And they're actually good at running Amazon stores. So they scaled and they get economies of scale. They scale these Amazon stores. And so go with me on some of this example. They raised $250,000, so $250,000 here, bought 5 stores for about $50,000 a piece. 1 year later, those stores were net free cash flowing $350,000. So what did they do? They took the net free cash flows of $350,000, paid back all of their investors of the $250,000 plus like a 20% increase or rate, interest rate. And the investors were so happy. Oh man, we made this investment. We made 20% in 1 year. This was awesome. But guess what? They didn't sell any of the stores. They still have the stores that are producing $300,000 to $400,000 a year. And they did it with $0 of their own money. You guys follow along with that? They raised $250,000, bought 5 stores. A year later, they paid back all their investors, and now they control 5 stores, enterprise value that's worth about $3 million in 1 year. That's working smarter, not harder. Is that kind of making sense? You guys follow along how cool this is? Okay, this is the next tier of entrepreneurship. It's pretty fun. Another example I love to share is about funeral homes. So I love this example. It's a friend of mine. I met him. His whole strategy, he found that he could sell funeral homes to this bigger private equity firm. They're a certain type of funeral home. He could sell them for 2x what he purchased them for if he grouped them together and had economies of scale. So what he did is he went out and bought like 8 to 10 of these funeral homes, groups them together. Let's just say they're $1 million a piece. So $8 to $10 million. He buys them together. He turns around and sells them for $16 to $20 million in about 18 months. He nets about an 8 to $10 million profit on that one transaction. He pays back his investors. He takes home about $1.8 to $2 million in a year, buying other people's businesses, grouping them together and packaging it and selling it to somebody else. Ta freaking da, dude. Isn't that kind of cool? Okay. So, isn't that awesome? Somebody's asking, how did they just pay back their investors? They took that example of the Amazon stores. They had net free cash flows more than the amount they paid for them. So they just took $350,000 of net free cash flows and just paid back their old investors. Kind of cool, right? Now that won't work for every single fund, but they had so much value and so much alpha that they were making that much residual income off these stores. They could do that. Kind of cool, right? Kind of fun. This is, you got to start thinking this way. Now I get this question all the time, Bridger, I don't have a fund. I don't have an idea to start a fund. I don't know what to do. A really cool idea is, number one, go find, first off, end buyers. Talk to private equity firms if you can. What are you looking to buy? What can I bring to you? Be a bird dog for them. What kind of business do you like to see? And I have a few friends in Utah actually that have done this. So they actually go and find restaurants that are like, everyone knows, like in a small town, there's like one restaurant that's just amazing. You guys know what I'm talking about? Like that one joint that's like mom and pop. They've ran it for 25 years and it's just, it's just unreal amazing. So what they do is, so you as the entrepreneur can show up to that store owner and say, wow, dude, your homemade pies are just to die for, okay? But why haven't you guys scaled to more locations? And typically they'll say, well, we don't want to scale. I want to control the shop. I want to make sure it's all done correctly, blah, 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 these great things. Or maybe they don't know how to do it. That's usually in the back of their brain. Like, I just don't know how to scale beyond one store. They're not that type of an entrepreneur. And you say, hey, well, I'm really good at scaling stores. How about we set up a licensing agreement or become partners or whatever, but let's try to launch 2 more stores in other areas. We're gonna standardize your whole process. We're gonna write every step down to make sure the quality of the product is really good. And we're gonna test out a new store. I'll raise the money for it. I'll put it all together. You just gotta help me make some really good, homemade pies. And what happens is you take these small local shops that make really, really good homemade pies, and all of a sudden you help them open up a second, a third, a fourth, a 10th location and help franchise and duplicate the model. If you hear the book E-Myth, it's exactly what you're doing is you're duplicating the model. They talk about this in the E-Myth book to do this. Kind of a cool idea, right? I know a couple people in Utah that do this right now, and they've blown up these little mom and pop stores to huge 200 store of restaurants now and industrialized these chains, these restaurant chains. Kind of cool, right? It's a really, now some mom and pops will say, no, I don't want to do it. But some will say, yeah, you know what? I've wanted to do this for years. I don't know how to do it. I'd love to work with someone like you. Okay. If you need an idea for a fund, that's a very, very cool fund idea that's happening right now. Additionally, if you don't do this, so if you're running a business right now, and you're like, I don't need to do this. I'll just stay small. I'll keep working. The problem is your competitors are coming. As much as you'd like to think, oh man, I lay concrete, I do landscaping, I run a restaurant, I do laundromat. Chances are competitors are coming. I'll share a couple examples. In Utah right now, and I've seen this around the country. Have you guys seen those like big car washes that are coming? Like Wiggy Wash, Quick Quack. Have you guys seen these car washes? They're massive. And they come through, they run like 1,000 cars a day. They have all these bays and everything. Those are backed by a lot of private equity and syndication money. They are scaling at mass. And if you had a car wash, oh, we're fine. We're just a local car wash. We're doing good. All of a sudden, a Quick Quack and a Wiggy Wash come around the corner and they run subscription models. They can outspend you. All of a sudden, your car wash is closed in 18 months. Competitors are coming. And usually, they're going to be coming with a lot more capital than you have with your small business. So a great example is have you guys heard of the cookie wars? Heard this concept? It's a concept that happened in Utah, not a concept. It's a real thing that happened in the last, 5 years. So a few years ago, this company came out called Chip. Okay, Chip made these nice, big, kind of a one-of-a-kind big cookie, and they were really doughy, and they were super yummy. And they delivered them to you any time of the night. You could hit the thing. They would, and this is before like DoorDash was big or whatever. They would actually deliver it to your apartment with a cup of milk. So a glass of milk and a cookie to your apartment or wherever you're at. Really cool idea. It took off in Utah. People loved it. They'd order these cookies. So then these other cookie companies started to copy and mimic what they were doing. Now, Chip was, in my opinion, the leader at the time. They were making the best cookies ever. And this other company called Crumble, you guys heard of Crumble cookies? Okay, Crumble cookies started in Utah. All these companies were in Utah. Chip decided to play small. We just want to keep quality. They didn't decide, but they just said, we're going to open up one or two, maybe 3 stores, and we'll just kind of do this in different small locations near college towns. Crumble said, let's take this same concept to new markets. Let's allow people the chance to raise capital, pool capital together, and use that capital to go across the country and set up franchises and build this model. A lot of the money that came into Crumble was syndications and funds would pull money together and set up store by store basis. Crumble now has a valuation near $1 billion, is the clear category king of this space, has absolutely taken over this whole market. Guess what Chip's doing? I actually don't even know if Chip's around anymore. They might have, I think they still have 1 store I know nearby. That's it. Your competitors are coming, and they're coming with this model. Whether you like it or not, well, you can ignore funds. I don't want to use a fund. Screw that. I don't care. Well, probably in a couple of years, someone backed by a fund or someone that has a fund with them is going to come and kick you out of your market, because the person who can spend the most to acquire a customer will always win. Let me say that again. The person who can spend the most to acquire a customer will always win. And typically, when people have this long-term life cycle and upsells behind just their initial product and have a higher cart value and a larger lifetime value of a customer, because they have multiple locations and they can scale with economies of scale, they have less overhead, they will outspend you and they will beat you. And as much as you want to deny that's not going to happen, blah, 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 they're coming. They will kick you out of your markets. You need to understand how this game works. And I hate to put the fear into you, but I think it's a good way to run a business a little bit. If you're getting relaxed, if you're like, oh yeah, we're just chilling, private equity right now is on the rise like crazy. It is taking over pretty much every industry in the country right now. They are coming. And so you need to figure out either how to hunker down, I guess, and just hopefully they don't bother you, or you can be proactive and say, you know what, I'm going to get ahead of the curve. I'm going to figure out how these funds work, how to put them together, how to either partner with one, how to build one, how to raise capital, and how to expand my current efforts. And put road and blockers up for competitors that they don't even want to mess with you. They don't want to come in the same market as you, because wow, these guys are obviously very well backed. They know marketing, they know strategy, they've got economies of scale, they have high lifetime value of a customer. You know what? It's not worth our time to go after that market, because they're a category king. At Fund Launch Live, I gave a talk about category kings. Every single market has about 1 to 2 major category kings. It's very hard to disrupt a category king once they are the category king. It almost never happens. So for example, Google, right? Google is the clear category king of search engines, right? They're amazing at it. About 10 years ago, Microsoft invested over $1 billion into Bing. You guys remember Bing? Okay, still's around. 10 years later, $1 billion spent. How much market share does Bing have? And this is Microsoft, one of the biggest companies ever, is like, hey, we're going to disrupt Google. We're going to take over their market share in this red ocean of category king space. Today's Bing has less than 3% of market share of all search. Yahoo has like 2.5. There's a couple like Baidu in China has like 1.7. Google has over 93% of all search still happens on Google. Why? Because they were the category king. So what's the second largest search engine in the world then? Funny enough, it's YouTube. YouTube is the second largest search engine on planet Earth. It's not Bing. It's not Baidu. It's not Yahoo. It's YouTube. Because YouTube decided to take a different approach. They didn't try to compete directly with someone else. They went into a blue ocean, created a brand new blue ocean of video search. And eventually Google bought them for, I think it was like a $500 million or $1 billion acquisition. And by the way, it was one of the greatest acquisitions of all time. People talk about that acquisition till to today. One of the greatest acquisitions ever was them spending $1 billion to buy YouTube. Okay. And so if you're not thinking this way and becoming a category king in your space, then somebody else will become that category king, and you're going to be eating the crumbs. Usually the category kings eat anywhere from 50 to 90% market share for a category, and the rest of the other 30 competitors eat all the crumbs, 1 to 2% of market share. If you want to scale, bolting on a fund is an incredible way to do it. This works for businesses. If you guys missed the beginning, I talked about Amazon business. It can work for concrete companies. This can work for funeral homes. Okay, this can work for restaurants. You guys need to think about having a fund. So if you guys are interested about learning about funds, we have a free course below. You guys can check it out. Learn about funds. We do one-on-one stuff. You can hop into our Black Card program. It's amazing. It's awesome. So go check it out. We do a ton of cool stuff. But this is something that you guys need to think about inside of your business right now. And also, if you can start your business with the idea of running a fund and not doing it as an afterthought, you're so much more ahead of the game. So I want to answer some questions here. Great content as always. What do you think about carbon credits? Rich Dad says it's going to be bigger than Bitcoin and gold. Yeah, so Bill Gates has been buying a ton of land for carbon credits. It's a huge environmental thing. It's one play. I wouldn't bet the whole farm on it as a kind of a joke, but I wouldn't bet the whole farm on carbon credits. I think it's a cool thing. I think it's happening in a major way. It could be bigger than Bitcoin or gold or other things. I personally don't think we're there yet, but I'm always down to throw. I have just so you guys know, on my personal portfolio, I do the 40-40-20 rule. So 40% is very safe, long-term, like the stupid, boring investments make me 2% a year. 40% is mid-tier risk. That's real estate, that's stock, like, blue chip tennis type of stocks, some tech stocks in there. Real estate goes in that category. My last 20% is my shot at glory. So if you see something like carbon credits and it's like, hey, this could be, it's when I talk about a shot of glory, it's got to be a shot of glory. It can't be just, it's okay. It's got to be like moonshot. So 20% of my allocations of my investments, at least personally, go into what I call a moonshot or big return category. So carbon credits would go into that category. I think it's worth throwing some dollars at. At least for me personally, I'm not giving you guys financial advice. Do your own due diligence, but it's pretty interesting right now. So yeah, good question. What do investors want to see to invest in someone's fund? At Bridger Pennington. Yeah, good question. So what would an investor want to see? They want to see just all you got to think about. It's so easy to get caught up in like all these metrics and statistics and how of Sharpe ratios and return on capital, like all these different metrics. Really what an investor wants to see is that you have alpha. And what is alpha? Alpha means that you have whatever your idea is or thesis or market plan, that you can find a high amount of return for a low amount of risk. That's the most basic definition of what alpha is. That difference, because most people believe high risk, high reward, right? Low risk, low reward. In investment funds, we are trying to tell an investor, hold up, I have found something. It's actually high return for relatively low risk. Does that kind of make sense? So for example, let's say I am just incredible at running restaurants. Back to the restaurant example. I'm really good at restaurants. I just know how to scale them. I've scaled 100 restaurants before. Okay. Now, in general, restaurants are, let's just call it this level of risk and this level of return. However, if Bridger and maybe Gordon Ramsay are on a team together, that's a better example. Me and Gordon Ramsay are a team together. Do you think we'll be more successful or less successful than the average restaurant? Probably, especially with Gordon Ramsay, maybe a little bit more successful, right? But we have the same level of risk. The fact that we have Gordon Ramsay, who's done this 1,000 times, means that we have a higher return for a little bit lower risk profile. All of a sudden, that difference is called alpha. Does that kind of make sense? So what you're trying to show to an investor is that you have expertise in a certain area or category that allows you to have alpha. So for example, I gave you that gun shop owner. He's really good at scaling gun stores. He's done it a bunch of times. So to an investor, he says, hey, I'm really good at this gun store thing. If you guys give me some money, I'm going to go buy competitors' gun stores. And I have a very high success rate on this small little niche of what we're doing. Okay. So that's what I mean by alpha. How much money should someone be managing by themselves before starting a hedge fund, or how much business net income should we have before a business fund? Good question. So the first question for a hedge fund. So there's a lot of different strategy things behind hedge funds. For that one specifically, usually you want a number of things, at least that I think. A good test portfolio. So whatever your thesis is, run a true test portfolio. I always tell traders, it's one thing, traders do this all the time, like they pick out their 5 greatest trades of all time, That's all they talk about. Oh man, I bought this trade at so low and went so high. It's like cool, but tell me about the other 50 trades where you lost money. Show me a full holistic view of your full account, not just your best ones, but show me your losses as well. That's a true test portfolio. Does that make sense? I would run a full test portfolio with your personal money. So I would run it with whether it's $1,000 or $5,000 or $50,000 or $100,000, whatever it is. Run the test portfolio and even have somebody else. You can hire brokerages or third parties to come in and just audit and check to make sure it's done correctly. I don't think it matters as much the amount, as long as it's over like a couple $1,000s, I think you'd be fine. As long as you can get into the positions you want to get into for that test portfolio. So, and then what you could do next, if you want to just step into it, you could do a hedge fund incubator. So that's a smaller, essentially the same version, but it's truly like a small hedge fund. It's a couple $1,000s to set up. And then you can do that. And then once you're ready, do a full-blown hedge fund from there, and you can actually raise capital. The nice thing about hedge funds, you can even start small. You can start a full hedge fund with even $100,000 or $200,000. And then you can just keep adding money. As you grow and do better, new investors can join and add money in, which is kind of cool. So you can really start whenever. You can start with whatever you want. Make sure your test portfolio is pretty good, though. That'll help you raise capital. Next one, how much business net income should be before a business fund? It more depends. It's less on the dollar amount. It's more on the expertise level of the person. So if you're really good at concrete, whether you've done 100 million or 5 million or 500,000, it helps. It helps. Obviously, you've done more, but I'm more concerned about your expertise and what you've done with the money or the opportunity you've had so far. It's like the story in the Bible, right? The guy he was gifted, that gave us, I think it was the servants, the talents. The guy that got 5 turned it into another 5 to 10 total. The guy that got 3 turned into 6. The guy that with 1, though, buried it and essentially didn't do anything with it. So if you can show, hey, I had 1 talent and I turned it into 2, or I had 3 talents, I turned it into 6, that's more important to me than the actual dollar amount. Awesome stuff. Bridger Pennington, what is the minimum amount a fund should raise or have under AUM to make it worth it? Yeah, good question. I personally, my first fund, if you guys know my story, my first fund in college. I was 22 years old. I raised $49,500. That was my first fund. $49,500. Now, I didn't make that much money from that fund. I made, what was it, like 5 or 8 or 10 grand over that fund, maybe over like 6 months running that. We got our investors, though, a 64% return in 6 months. They were ecstatic. It was like, holy crap, this is amazing. Now, small dollar amount, but good return. So what did I do after 6 months? We actually closed it down and restructured it and launched another fund with that track record. And then we went out and raised and deployed millions of dollars out of that fund. I ran that fund for 3.5 years, did very, very well. We got huge returns to our investors. And then about 2 years ago, 2 years ago, a competitor came and bought that fund from me. And actually, I sold the fund. I had an exit. Kind of cool, right? I would have never done that second fund if I didn't have that first small syndication. I think there's so much value in starting. Now, make sure you're ready. Make sure it's whatever. Make sure you've learned. That's why we have this company called Fund Launch. We teach you all the stuff in funds to make sure you're prepared and you're not doing things fraudulently. So if I was somebody just starting out, what I would tell them, come educate yourself like crazy. Come hang out with fund managers. Proximity is power. Be around. That's what we've done with Fund Launch. We create a community of people to hang out and talk funds and learn stuff. Okay, so learn the game, number 1. Number 2, start the game. There is so much power going from 0 to 1. Making your first dollar is massive compared to making $0. Making $1 is huge, okay? Make $1. Get started. I don't care how big it is. I believe it's worth it because we're not playing the short-term game here. We're playing the long-term game. The game of funds is a long-term game. And if you play it right, you don't get rich. You get really, really, really generational rich and wealthy. The Forbes 100 list is full of fund managers that decided to play the long game of funds. So personally, I'm in this game for decades, right? And I'm going to set the groundwork now. I'm going to learn. I'm going to educate. I'm going to build partnerships. I'm going to network. I'm then going to start funds, whether it's big or small. I'm going to keep starting funds and build a good track record as a manager. It's funny, I did studies on Warren Buffett and Ray Dalio, both their first initial funds. I think Warren Buffett raised $100,000 for his first fund. That was it. 100 grand. But he started. Ray Dalio, and he was like 28 years old. Ray Dalio started when he was 27, his fund. They raised like something like, it was like less than 100 grand for their first fund. There's a lot of power in starting. So that's what I would say. Get started. Woo, okay. Y'all are amazing. The link below, if you guys want to learn more or hop, we have a free course on funds. We have a mastermind program. It's $2,000. We have our top tier black card program. We actually coach and work with you one-on-one. We help your legal. We help you get set up. You get to be in our mastermind group. We do 3 events a year together. It's amazing. If you want to talk about that more, go to fundlaunch.com or hit the link below. You guys can hop on a call with one of my team members right out here. They'll talk to you all through it and help you out. And you guys get in, you join our private Slack channel, be able to message me back and forth. I'll send videos to you, all that kind of stuff. You guys can hang out. We have about 400 members in our black card group. It's a hoot. We have a really fun time. We have incredible people in black card. So that's what I'd say. Okay, I'm going to hop off for today. You guys are amazing. Please like this video, comment, subscribe. And I'd love to see you guys post questions in our Facebook group. Go live. I want to hear your stories. I mentioned 2 days ago, you guys have the ability to go live in our Facebook groups. Go live. Tell us your story for 2 to 5 minutes, and then ask the group something. Hey, I'm struggling with raising capital. I'm struggling with finding partners. I'm struggling with finding deals. Walk us through it, and maybe people can help you out. So go live in the group. You guys are amazing.